Alright guys, welcome back to another video, and today we're going to talk about a few things, so let's get right into it. The first thing is I'm going to talk about the uptick of daily coronavirus cases we're having and the effect that it'll have on the reopening of the economy. Secondly, we're of course going to go over my M1 account, and today we hit another exciting milestone. The account is now over $19,000, so we're going to talk about the changes I might have made. Finally, because of this whole pandemic, a lot of companies are going under and have declared bankruptcy. And today specifically I'm going to talk about Chesapeake Energy, which if you saw from my previous video, you would know that I had a brief one-day stake in the company, and we want to talk about the fallout of the bankruptcy. So let's get right into it. But before we do, I want to show you this video that I found that's pretty amazing, and it kind of explains why there's a daily uptake in coronavirus cases.
See that flag? I would die for that flag. The Constitution that you are supposed to uphold, I would die for that.
Would suggest to muffle people, to put masks on our face, to keep us from breathing oxygen, to get us to become sickly.
You preach pseudoscience and safety. Does anyone care about preserving the liberty of the people who pay your salaries?
They want to throw God's wonderful breathing system out the door. Can you prove that it's good for people to breathe carbon dioxide over and over and over again?
What about PTSD from child abuse situations? I was left in a hot car. You want to cover my face? I'm going to hyperventilate.
You literally cannot mandate somebody to wear a mask knowing that that mask is killing people.
You're not God, and since masks are harmful, where there is risk, there should be choice.
As you can see, these residents of Florida, they were just basically voicing their disapproval of requiring people to wear masks in public. Thankfully, the measures were approved, so people now have to wear masks. But from people that you listen to, and I'm sure you have people within your social circles or even in your family who might disagree with wearing masks and social distancing and things like that. But because we have a segment of the population that feels so strongly against this, it really isn't surprising that even in Florida, they now have nearly 9,000 confirmed cases of coronavirus in a single day, which is a new record. And it's not just in Florida too. Only a couple of days ago, a Texas governor basically said that Texas was wide open for business, despite the fact that cases were rising in Texas as well. But surprise, surprise, he now orders that all bars are to be closed while they try to get the coronavirus under control. And this is basically happening in everywhere. A lot of states, mostly in the southern states and also the western states, California being another big one, they're all showing upticks in the coronavirus cases, as you can see from the graph. But when people talk about the first wave, it was right here where it peaked at almost 35,000 cases per day, and it slowly seemed to go down when the government implemented social distancing measures and staying at home. But now with the government and states individually relaxing their stance, the cases are now going up much higher. Of course, people will be saying, oh, where's the death rate? The death rate might still be low. So overall, the death rate percentage or the mortality rate is quite low. But regardless of that fact, seeing this massive and exponential rise of new cases is very alarming. So it isn't surprising that states are now retracting their reopening plans, and it's same goes with companies as well. The biggest company in the world, at least the one that has a lot of weight and sway in the market, is basically Apple, and they announced that they're reclosing a lot of stores that are in these states that are mostly affected. This article states that Apple had temporarily closed 32 stores in 5 states, those 5 states being Arizona, Florida, North Carolina, South Carolina, and also Texas. And of course, this is a very necessary move. Apple, of course, is a company, they want to make sure they're not liable and they want to protect their employees and also the customers. So closing down the stores makes sense, and especially for Apple, it's not like they're going to take that big of a hit, because even though they do have their physical retail location where people are able to come in and try their products, they have a very strong online presence. So even though their physical stores might be closed, and sure, they might lose some business from that, they're not completely 100% cut off because they once again have their online business. Another way this is able to be flipped and is able to showcase that Apple is willing and they care about the health and safety of those others. And Apple's also be able to shift things really quickly. As you can see, they had their WWDC conference, but this year, because of the whole pandemic, they basically switched it to an online model. I have to say it's very quite well done. All the presentation, of course, is very fluid, and I feel like that this method of presenting the keynote was more effective because you didn't have audience like applauding and chiming in and kind of breaking the flow of everything. By Apple doing this, it's basically forcing other companies who might not have any plans to shut down their stores. It's basically forcing other companies to follow suit, because if they don't, they're going to be basically labeled as not caring for the employees or the customers or the overall health of the economy. And the sad thing is, not a lot of companies are able to completely transition online. As I'm sure you know, restaurants are suffering and retailers are suffering, and as a result, we have seen a wave of bankruptcies. Even Nike, the big component of the Dow Jones, they also reported unexpected losses as sales tumbled 38%. And even though they did see a digital sale increase of 75%, the expenses attributed to shipping and returns basically put more pressure on their profits. And for a lot of companies, this resurgence is going to be the final nail in the coffin. They might have been able to skate on by, or they might have pinned their hopes on this reopening effort, but because of this resurgence, companies are undoubtedly going to be filing for bankruptcies or filing for protections or seeking out loans at higher interest rate, which they won't be able to pay off, because we don't know how long this pandemic is going to last, and with the vaccines not being out and about, a lot of people might be fearful, at least some segment of the population might be fearful to go about their normal lives, which will mean less revenues and more business faltering. But on to more exciting news, my M1 account is now over $19,000. Depending on where you are on your investment journey, $19,000 might seem like a lot or might seem like not at all. But for me, it's another great milestone for me to hit, and as you can see, I'm only a couple $100s away from hitting that $20,000 milestone, which is very exciting. But in terms of investing, I haven't really been doing anything much different. That's something that you would find a lot in most of my portfolio updates. Is I still have the 56 companies and bond stocks that I have. I have 5 ETFs in the bonds, and every other pie basically has 10 different companies. So every week I still deposit the money, and every week I buy the same companies depending on the allocation, and I let M1 Finance take care of that. I just deposit the money, I just change the dollar amounts here, and it automatically invests in the afternoon or in the morning or wherever I end up choosing to invest in. But to be more transparent and to show you the trajectory of my account balance, this is a small graph that I created. I wanted to go over this before we move on to the final bankruptcy topic. So the C column is going to show numbers from my previous video. This is the information that I input in today. This is the dollar changes that have occurred from the previous updates to today, and this is a percentage change. The first row is going to be the portfolio balance. As you can see, it was $18,700 before, but today's $19,200. So my portfolio, it went up 2.6% or almost $500. But the thing is, this isn't purely profit. You have to also consider how much money I personally put in. So the next row is pretty important. I put in an additional $830 between the last time I uploaded the video and what I have right now. But the portfolio only went up $486, which means in terms of market gain, I actually am down $343. So if I didn't put any money in, and if I change this back to what I have previously, it will be much worse than before. In terms of market gain, I'm down closer to $500. The final row highlights my portfolio performance overall. In my previous update, I mentioned that my portfolio is now up 15.56% compared to the S&P 500 performance of, I think, around 9%. But to calculating everything today, my portfolio is now almost 13%. So it did go down almost 3%, but I'm not really worried too much because I'm still going to be contributing to my account regularly. I'm still going to be investing it regardless if the market goes up or down. But the key thing is whether this percentage is positive or negative, I'm still going to put in the money, so you're going to still see the deposit dollar increasing from the previous to today. And the market gain, I can't really control. I can only hope to pick good companies that I believe in. And some days the market is going to be up, but other days the market's going to be down, and I'm going to be down a couple $100. But if you're investing, try not to be swayed by the daily swings of the market. If you believe and you pick companies for the long term, just invest consistently, dollar cost average like I'm doing now, and you're going to end up 10 years, 15 years later down the road, way richer than what you are currently worth. So that's what I'm hoping for. Sure, right now, today, my portfolio is only under $20,000, but I know in 30 years or by the time I retirement, this is going to be worth more. Even if you have only $100 to put in every month, put in $100 and watch that grow, because you might not be a millionaire, but by the time you're 60 or 70 years old, that $100 you put in consistently is going to be worth tens of thousands of dollars or even hundreds of thousands of dollars. That's the key with investing. Long term is always going to be better than the short term fluctuation, so focus on that. And as a quick reminder, because of the coronavirus, the tax season has been moved up, so now you have until July, so mid-July, to finish filing your taxes. So if you haven't contributed to the maximum Roth IRA limits, you have a couple of days to max out that IRA. So make sure you do that if you haven't maxed out your 2019 contribution. Now, with that said, M1 did send out an email, and this is the announcement that they have made, is they're moving their morning trade windows. It says, starting on July 1st, we're moving our morning trade windows from 10 a.m. Eastern Time to 9:30 a.m. Eastern Time. From now on, the window will coincide with the market open. And the reason why they did that is because the market, the New York Stock Exchange, it opens at 9:30. And it's usually at the very open that stocks are the most active, so they're traded with the highest volume than later during the day. So that's why M1 says they're going to move the window up 30 minutes so everyone can get the best price, because stocks are going to be trading closest to their overnight prices. And of course, some people might take this and not like it. I've seen a few comments saying that they don't like that they don't have that 30-minute buffer to decide if they want to invest in a certain company or not. And of course, that's true, but if you're truly passive investing, which is what M1 is trying to do, unlike Weibo or Robinhood, which is more actively trading, this change from 10 a.m. to 9:30 shouldn't really be an issue. Just remember, if you're going to be placing a trade, make sure you do it before 9:30, because now you don't have that 30-minute window like before. By the time this video is released, it will already be happening. So just keep that in mind if you're going to be using M1 Finance. And if you haven't started your investment journey and if you want to use M1 Finance as your account, use my referral links down below. So if you open up an M1 account and if you fund it, you receive a free $10 on top of whatever your money you're going to put in. If you watch my previous M1 Finance review video, you might have heard me talk about how M1 Finance handles IPO. I mentioned that when DraftKings IPO'd or when Levi's IPO'd, M1 Finance was very slow compared to other brokers like Robinhood or Weibo in updating and allowing you to buy or trade these IPO stocks. Same things happened with Albertsons. Their grocery chains that IPO'd on Friday, June the 26th. And as you can see, these are the screenshots that I took at 9:33 of that Friday of M1 Finance, Robinhood, and Weibo. If you look at Robinhood, you can clearly see when you type in ACI, which is Albertsons stock ticker, you see it visible. Same with Weibo. If you type in Albertsons or ACI, you see it visible at 9:33. But if you try to look up Albertsons on M1 Finance on the exact time, nothing shows up. So that's another thing I want you to keep in mind. Each brokerage have their own pros and cons. You can watch my video once again if you want to see my thoughts on M1 Finance, but they haven't really worked out the kinks showcasing the IPO stocks right on the day of their trade-in. So if you want to get in on IPO action, if you want to be trading in and out, definitely go stick with Robinhood or Weibo. But if you're okay with that slight delay, and I always don't really recommend trading into an IPO anyway, because you never know how they're going to be handling and how other people are going to be perceiving the company. But still, keep that in mind that M1 Finance, their IPO is a bit slower than other brokerage. So that's my final update for M1. And finally, the main topic I want to talk about is bankruptcies caused by the coronavirus pandemic. And we have a lot of companies have already filed bankruptcy because of falling sales and also bad business endeavors and situations prior to the pandemic. But we had Neiman Marcus file for bankruptcy. We had J. Crew file for bankruptcy. We have Hertz, 24 Hour Fitness, True Religion, Pier 1 Imports, and the biggest one was JCPenney's. But today, I want to talk about the bankruptcy announcements of Chesapeake Energy. If you remember from my last video, when I talk about my Robinhood trading history, I showed that I did have a short-lived stake in Chesapeake Energy where I invested $608 into their ticker symbol CHK, and even though I traded in and I sold the very same day, I lost $3. But if I held it until today, I would have lost basically all of that money. I would have lost $600. What happened to Chesapeake Energy to get them to this point isn't new. Other companies like JCPenney's and J. Crew and Hertz, they have all kinds of reasons why they had to file for bankruptcy. But I hope this serves as a cautionary tale on how we should handle our finances, because if we don't, we might also be on the verge of bankruptcy. So if you look at this article, it's going to say that the Chesapeake Energy, they took on a lot of debt to fuel their rapid expansion, and from 2010 to 2012 spent $30 billion more on drilling and leasing than it made from its operations. But in addition to that, they basically had no budget and they had some ridiculous spending, as their CEO found out. According to the CNBC article, it says CEO Robert Lawler found in examining the company's books a $110 million bill for 2 parking garages. Other revelations included a wine collection in a cave hidden behind a broom closet in the Chesapeake office. Extravagance further included a season ticket package to the NBA's Oklahoma City Thunders that was the biggest in the league, a lavish campus that was modeled after Duke University, complete with beekeepers, Botox treatments, and champagnes for employees. So that's a few reasons why Chesapeake Energy has to declare bankruptcy. They weren't good with their money, they expanded far too quickly using lots of debts, and they spent money needlessly on things that didn't really matter in the end. Which is what a lot of people can say about their daily lives. People make their money, they earn their paycheck, but before they invest or they put it aside for savings, we're too busy buying things and trying to keep up with the latest fashion trends and things like that. And sure, Chesapeake Energy, they're going through Chapter 11 bankruptcy, so they're going to restructure and they might come out on the other side without disappearing entirely. It's very interesting to see how a company which was once a pioneer of fracking has now been reduced to almost nothing because of their uncontrolled spending. And even though a lot of companies are going to be filing for bankruptcies, the crazy thing is that stocks that declare bankruptcy, they actually go up. As you can see, the hot new things to make your stock pop, which is to go bankrupt. Thankfully, that didn't happen with the company. The New York Stock Exchange, they suspended trading immediately, which is good. So no new investors or people who don't know what's going on, or people who get into bankrupt stocks thinking that they want to make a quick buck. It's good that the New York Stock Exchange halted trading immediately, so no one else would have to lose additional money, because look what happened to her stocks. Even though they went bankrupt, they came up with this crazy idea to fund their bankruptcy by selling more stocks. And the funny thing is, as they were planning to issue these stocks, they were at the same time telling investors, hey, just to warn you guys, the stocks that they're issuing is going to be worthless. But thanks to the SEC questioning their motives and going over the paperwork and basically telling them, hey, that's not going to be plausible, Hearst basically stopped that. They're now seeking to take out at least $1 billion in bankruptcy loans to try to save themselves. So because of this pandemic, because of the resurgence and the fear of the second wave and a lot of bankruptcies happenings, and because of the unknown, we're going to see a lot of volatilities happening in the market. And I want to make sure that as you watch this video and as you go about your investment journey, to make sure you understand what you're doing, to not blindly follow the fads, to don't blindly follow and put in money in Hertz stocks and other bankrupt companies because, oh, you think that you're going to make a quick buck. Sure, you might make a quick buck here and there, but over the long run, you're going to end up losing money. So stay vigilant and make sure you navigate this volatile stock market time well. So that's all I have for today. As always, stay safe out there, and I'll be back next time with more financial shenanigans.